Hey guys! In this video, we will show you our simplest way of trading using top-down analysis. This would help take your trading to the next level. From looking at the comment box, the question that has been asked many times is, how do we use top-down analysis?
Before I forget, please make sure to click the subscribe button and hit the notification bell, so you know precisely when we release new content. What then is top-down analysis? Top-down analysis is a popular approach forex traders use to gain a holistic understanding of the market. It involves analyzing the forex market from a macro to micro perspective, starting with higher time frames and gradually narrowing down to lower time frames. This tutorial will guide you through the steps involved in conducting top-down analysis and provide insights into the time frames required for each level of analysis. Let's look at some examples to throw more light on this topic. If the price is making a higher high in a lower time frame, let's say the 1 hour time frame, this is taken as a bullish trend. The line is drawn and the bottom. Let's now assume that on the daily time frame, the trend is making a lower low. This tells us it is a bearish trend. The trend line is drawn above, this is called the resistance line. Let's relate these two time frames together and see how this works. The one in red is the higher time, which is the daily time frame. It is a downtrend and the trend line is drawn at the top. On the other hand, the black one is the 1 hour trend and it is making a higher high, which tells us that it is an uptrend. Since it is an uptrend, the trend line is drawing at the bottom. Let's us join the two-time trend together. Please note that a chart on the higher time frame is more respected. Looking at the chart, it shows that the 1 hour time trend is in an exhaustion state, and would have been wrong to trade a buy at this point. This shows that if you had taken a trade at that point, the trade would have been in the opposite direction. Please note that trend lines have been taught in other series. For you to understand this topic, you would learn trend lines very well. If you want to know more about trend lines, go to my channel at the link below after this topic. Let's continue. The daily time frame is a downtrend and the 1 hour time frame is an uptrend, so it is very important to start your analysis from a higher time frame. You have to know what type of trader you are: scalper, intraday, and swing trader. In the case of a scalp trader, you should look to trade within a few minutes and you are out of the market. In such a case, you have no business with the monthly time frame. The next set of traders are the intraday. They do more daily trading. Now then, if you are a swing trader, you will hold your trade for weeks and 4 or 5 days or longer. Let's know the best time for the 3 sets of traders so you can decide the best time to use and that fits your trading skill. You need 3 major time frames for a very good top-down analysis. What are the major time frames you need? First, the higher time frame. You need your medium time frame and your lower time frame. For the higher time frame, you would be looking to see the whole structure. You try to read on the market structure on the higher time frame. Secondly, you move to your medium time frames. That's where you map out your plan after doing a proper check on the market structure. So once you map out your plan on the major time frame, you still try to identify your medium time frame structure. Your lower time frame is where you look for the entry. Here is where you find out when you can enter a trade. Now for the scalping trader, this set of traders on the 1 hour, 15 minutes, and 5 minutes. Most traders work on the 3 time frame using a formula. It is 4 times the entry time frame to get the medium and 4 times the intermediate to get the higher time frame. An example is the intraday trader, which is daily, 4 hours and 1 hour. The swing trader uses the monthly, weekly, and daily time frame for trading. Let's go to the chart for a better understanding. Please note we use trend lines in combination with price action in two key ways. The first is for trend trading, and the second is for reversal trading. We would explain this with a multi-time frame. Now let's use the daily time frame first as our higher time frame. We first identified that this was a moving downtrend through the lower highs and lower lows, and again we would want to trade with the bigger downtrend. You would have had your trend line established through these points. So it is drawn and extended further down very well. You also need to draw your support and resistance line. There would be a place where the two trend line intercept. This area could be taken as the confluence area. At this time, it might be clear what step to take. This is where the price would break through or reverse, because again this short time moving trend is an uptrend. Your big picture trend is bearish and a downtrend, while your short-term trend is bullish in an uptrend, which means you have a conflict in your directional bias. It is very important that you don't rush into a trade. Please, when planning a trade, you have to do a very proper study. And also note that the price touching your resistance line is not an assurance for trade. You have to study the reaction that price has made at the confluence area. This has to be properly checked using price action. Once it gets to the confluence area, you would want to see the next reaction. The next thing to do is to step down to a lower time frame, precisely the 4-hour time frame, where you can see more information on the trade. Let's put the two time frames together for better information, that is, the daily and the 4-hour time frame. Notice the 4-hour time frame shows more information about the price and the reaction taking place at the confluence area. Let's look at it very well, and see how to work with this information. In the 4-hour time frame, the price was clearly reducing in momentum as the price came to the resistance line. We can clearly see that the small bullish trend was getting weaker and that the bearish trend is getting stronger. You can now draw a trend line in the 4-hour time frame, and if the price breaks through it, you would be able to tell where the price is moving to. Now it clearly shows that the price is moving to the downside. The price is respecting the bigger trend, which is the downtrend. And this is the trend we should be hoping to trade with. The information has helped us to confirm our directional bias. We can go into the lower time frame. It could be a 1-hour time frame to take a trade. Trading requires complete studying of the chart. It is better not to guess at all. Try understanding what you want to do on the chart before taking any action. There are several reasons why you might want to use top-down analysis. First, it can help you to identify the overall trend of the market. This is important because it can give you a better idea of where the market is likely to go in the long term. Second, top-down analysis can help you to identify potential trading opportunities. By looking at the big picture, you can see where the market is likely to retrace or consolidate, which can provide you with good entry points. Here are the steps involved in doing a top-down analysis. Start by looking at the highest time frame, such as the weekly or monthly chart. This will give you an overview of the overall trend of the market. Once you have identified the overall trend, you can start to look at the lower time frames. For example, if the market is in an uptrend on the weekly chart, you might want to look at the daily or 4-hour chart to identify potential trading opportunities. When you are looking at the lower time frames, you should pay attention to the following factors: support and resistance levels, trend lines, Fibonacci retracements, volume, moving averages. Once you have identified a potential trading opportunity, you need to decide whether to enter the trade or not. This decision should be based on your risk tolerance and trading style. Tips for top-down analysis. Here are some tips for top-down analysis. Use multiple time frames. This will help you to get a better understanding of the overall trend of the market and identify potential trading opportunities. Use technical analysis tools. These tools can help you to identify support and resistance levels, trend lines, and Fibonacci retracements. Be patient. Don't rush into trades. Wait for the right opportunity to present itself. Use a risk management plan. This will help you to protect your capital and avoid large losses. Conclusion. Top-down analysis is a powerful trading strategy that can help you to identify the big picture and make better trading decisions. However, it is important to remember that no single trading strategy is perfect. You should use a combination of strategies and tools to increase your chances of success. Trading requests a lot of assistance to improve. All this you can get from this channel. I am ready to help your trading to a new level. All I need from you is to please subscribe to get other videos from me.